You are listening to KeyStone Stock Talk Podcast, episode 61. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, in our Your Stock Our Take segment, we take a look at BioSyent Inc., symbol RX on the TSX venture, a Canadian specialty pharmaceutical company whose primary product is FeraMAX, an over-the-counter iron supplement. A listener asks us if it's a time to take a look at the stock once again in 2019. Our star of the week should be no stranger to KeyStone Clients, having been a recommendation just over a year ago. Zynex Inc., symbol ZYXI, now on the NASDAQ, which manufactures and sells non-invasive medical devices for pain management, stroke rehabilitation, cardiac monitoring, and neurological diagnostics. Its primary offering is electromagnetic or electrotherapy medical devices used for pain management and rehabilitation. The stock has surged 82% year to date, and roughly the same amount since our recommendation to buy it over a year ago. The company recently announced it has graduated to the NASDAQ exchange and will be announcing its 2018 annual results and outlook next week. Finally, our dog of the week is Lassonde Industries Inc., symbol LAS.A on the TSX, a North American leader in the development, manufacture, and sale of a wide range of ready-to-drink fruit and vegetable juices and drinks. The stock is down over 13% over the last couple days. Is it a dog or opportunity? We will let you know. I'm going to get right into the show. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Our Your Stock, Our Take segment, the question comes from Monty via Twitter. He asks, from what I see, BioSyent is a profitable and growing business. It's been growing long term. It sounds just like something KeyStone would put into its recommendation list. What is your take on it? Well, BioSyent, symbol RX on the TSX venture, currently trades at around $8.06. Its market cap is $115.96 million. What does the company do? They are a specialty pharma company. They source, acquire, or in-license and further develop pharmaceutical and other healthcare products for sale in Canada and to certain international markets. The primary product is FeraMAX. It's an over-the-counter iron supplement. In fact, it's ranked as the number one iron supplement recommended by both Canadian pharmacists and physicians. The company also has a legacy division that operates as this legacy business. It markets biological and health-friendly non-chemical insecticides. Let's look at the last quarterly statements. Revenues fell 3% to $5.4 million, or from $5.4 million to $5.3 million. Adjusted EBITDA fell 10% to $1.8 million from $2 million, and cash flow fell 17% to $1.6 million from $1.9 million in the same period last year. Now, our take. Q3 marked BioSyent's 33rd consecutive profitable quarter, which is definitely a positive. Having said this, the company's revenue declined year over year in the third quarter for the first time in years. The positives here, its Canadian pharmaceutical business, which is the core to its business, delivered 11% growth during the quarter, with growth generated across its product portfolio. Now, the near-term negatives, the company's international pharmaceutical business faced some challenges due to trade restrictions in particular export markets. While management does not expect these challenges to persist over the long term, the company anticipates further instability in international FeraMAX sales in the near term. Growth in the company's legacy business during the quarter also declined when compared to a strong or particularly strong Q3 2018. What we need to see is further traction in sales of products outside the company's highly successful FeraMAX product line. It has been a bit of a one-trick pony. Fundamentally, the business does boast a great balance sheet, $22.6 million in cash and cash equivalents, and it continues to grow. That's $1.56 in cash per share with no debt. Removing the cash, the stock trades at about 17.2 times trailing earnings, which is slightly below the market average. We expect the core Canadian operations to grow at 10 to 15% in 2019, not including potential acquisitions. The international business, as we stated, will be weaker near term. Given this uncertainty, and despite the fact we like the cash generation and see better value we have in a number of years in the stock, we continue to monitor it at this point for potential entry points in 2018. If we see a catalyst for growth, we may enter. We're monitoring right now and not currently buying. Our weekly star. From our Stars and Dogs segment, it's time for this week's Star. Is Zynex Inc., ZYXI, now on the NASDAQ exchange. No stranger to KeyStone Clients, as it's been a recommendation over the past year. Currently, it trades at $5.22, $169 million market cap. What does the company do? It is a medical technology company specializing in the manufacture and sale of non-invasive medical devices for pain management, stroke rehabilitation, cardiac monitoring, and neurological diagnostics. The company's primary business is the marketing and sales of its own design of electrotherapy medical devices used for pain management and rehabilitation. Zynex has jumped more than 80% in 2018 already, and 40% in the last 5 days. What is driving the stock? In the end, it's the underlying numbers, the cash flow that drives the stock, and Zynex has delivered year-to-date in 2018, producing record earnings. However, the company also recently announced an important event in the evolution of its business. In the past couple weeks, on February 7th, 2019, management reported that its common shares have been approved to list on the NASDAQ capital markets and begun trading on February 12th under its existing symbol ZYXI. While this listing itself has no impact on the daily operations of Zynex, nor will it improve the underlying numbers and fundamentals, it can help the company communicate its story to a broader audience, particularly institutional investors. Zynex was recently recommended in December 2017 to our clients, with the stock trading in the $2.95 range. It is an excellent example of the type of discovery research Keystone Financial provides clients in our U.S. research. The stock had basically zero coverage when we recommended it as a high-growth, now cash-rich business with zero debt. It has delivered record earnings and now graduated to the NASDAQ, fulfilling a management promise. The stock has now increased 78% since the recommendation. This does not include the 7-cent bonus dividend it paid to shareholders early in 2019. Our clients received a full update last week on the stock, which expects to grow once again in 2019 following a record 2018. The stock performance year to date over the past couple weeks and graduation to the NASDAQ make it our star of the week. Congratulations to clients who purchased on our 2017 and early 2018 recommendations on the stock. Finally, our dog of the week. From our Stars and Dogs segment, it's time for this week's dog. Lassonde Industries Inc. LAS symbol on .A on the TSX. Current market price is around $175.50. Market cap is $1.22 billion. Stock is down just over 13% in the past 2 days alone. What does the company do? Lassonde is a North American leader in the development, manufacture, and sale of a wide range of ready-to-drink fruit and vegetable juices and drinks marketed under the brands such as Apple and Eve, Everfresh, Farrelly, Fruity, Graves, Oasis, and Rougemont. Now, what is driving the stock lower? Well, weaker than expected Q4 2018 results. This week, the company announced that its operating profit will be down 40% to $25 million in the fourth quarter from $42.4 in the fourth quarter of last year. As at Q3 2018, so coming out of its last quarter, management had only stated that given a weaker current environment, it expected only a slight decline in operating profit in the last quarter of 2018 compared to the same period of 2017. That 40% decline in operating profit is not a slight decline in operating profit, and thus the sharp drop in the share price that we've seen over the past several days. Our conclusion, Lassonde stated that it is adjusting its business model to mitigate rapidly rising input costs. The company aims to improve its utilization and production capacity by replacing low-margin contracts with contracts that better reflect the current state of the U.S. market. However, a delay in finalizing one of these new contracts and strong pressure from the company's main competitor in the U.S. have affected sales. We, therefore, expect near-term pain to continue. The company is well run, but growth has stalled over the past 3 to 4 years, and there's some uncertainty at present. We monitor it as valuations are decent, but growth would have to accelerate for us to be an investor in the stock. The drop this week gives it the not-so-coveted status as our dog of the week. I'd like to thank everybody for listening once again this week to a quick show, but we got 3 companies in there. Thank you again for all your questions coming into our Your Stock, Our Take. Hit us up on Twitter or the regular social media channels, or just send us an email or give us a call, and we will answer your questions in our Your Stock, Our Take segment. Thank you again, and I wish you profitable investing.